everybody, and thank you for being here at the Subscriber Summit. It is March 4th, 2017 in Toronto. This is my third year of being involved with Keith and Eric doing this conference, and it's important for me to thank everybody. I value the community aspect and the knowledge sharing that takes place both at these shows and on the CEO.CA site every day. My guest for the next 20 minutes or so is Warren Irwin. We have an incredible privilege to have Warren back for the second year. In the most recent week, there was a study of 4,000 hedge funds. In 2016, there are 3 or 4 funds under his family of Verso funds. He received the #1 performing hedge fund, the #2 performing hedge fund, and the #6 in the world. So we're literally standing next to the hottest hand in the hedge fund world in the world. And that's a good start, I think. No pressure, Warren.
Yeah, it was just 1 year, don't worry. We lost a lot of money the previous few years, so.
So in 2014, I met Warren on a site visit, and I was drawn to him because he was skeptical and funny. It was a site visit to NextGen Energy's Aero project. And I think it was September 2014. And he was a Fission shareholder at the time, which had an exciting discovery and was kind of getting a sense for what NextGen had. He told an incredible story about Bre-X, which he amazingly shorted. And I stayed in touch with him, and over the coming months, drill results from NextGen encouraged Warren to take a position. And then as more science and evidence came forward, he took a bigger position and ended up becoming probably the largest outside investor in the company. And about, I don't know, maybe fall of 2015, Warren saying to me, you know, like the market's got to get wise to this situation. And he had created a model for what he expected the NextGen's maiden resource to be. It was, he modeled it at 200 million pounds, which would be by far and away the best exploration success in the basin in decades. Hathor, another company, was sold with a 60 million pound resource. So Warren had me, and I was happy to help him, trying to communicate this to some analysts and newsletter writers. He was literally saying to anyone who would listen that he would show them their model and wanted the evidence to come forward. So you know, we tried that little lobby effort for a few weeks, and some newsletter writers just weren't getting it. And so I said, well, why don't I write the story for Warren about Bre-X and then what he sees in NextGen. And that was probably the most popular story in our site's history. And in the year and a half since we published that story, when Warren predicted a 200 million pound resource, well, 4 months later it came out at 202 million pounds. It was extremely precise. And since those articles and Warren's championing of the story, there's been more than $1 billion in market cap gains on that stock alone. And I believe that there are thousands of NextGen shareholders that are so as a result of Warren sharing his model. And it's by far the most popular channel on our website, with like 35,000 hits a month, if you can believe, just on the NextGen page alone. And it's made a fortune for investors, and Warren has a huge, huge position in it that's got richer and richer. He's up almost 1,000% on the name. It was a conviction holding for him. So first I want to say thank you, Warren, for sharing that idea with us, and congratulations on a damn good year. NextGen is on the eve of publishing its second resource, and I think some excited investors on my site were hoping that it would be out pre-PDAC. Do you have any comment on the pending resource?
Yeah, as far as the size of it, everybody's asking me what my model says, and I know exactly the size of the next resource estimate.
Okay.
And I'm starting a new newsletter for $9.95 a month. And so, yeah, the most important thing to remember about the next resource estimate and the size of it is it really does not matter. And the reason it doesn't matter is this. You saw they did the cutoff as of the end of last year for the resource estimate, and they just blown it out of the water again with these new results here in 2017, where they've done step outs of the A2 shear and the A3 shear. It's clear that this resource estimate, whenever it comes out, in my opinion, it'll be out of date by the time it arrives. It's clear that the deposit is getting much, much bigger. It'll be much bigger than second resource estimate. So whether it's 400, 450, whatever the number ends up being, it'll be out of date by the time it gets published. Now, the reason I didn't go public with a resource estimate this time, I got into modeling it again. I was spending put probably 20 hours into updating it from my last model. And it was clear to me that for me to get my next estimate out, I would have to make some assumptions, and I'd have to almost guess what RPA was going to make as far as assumptions go. The first time around, it was quite a bit easier because there were, first of all, a lot less holes, and when you're modeling it out, you don't necessarily have to worry initially, you don't have to worry about the difference between indicated and inferred, and now in the next round here, there will be a big movement from inferred into indicated, and there are a number of assumptions RPA is making that frankly, I don't know how they're going to approach it. So my assumptions would just be quite a bit different than theirs. And, you know, with the error, a typical error, you could be plus or minus 20% on this. So to give you a sense as to the magnitude of that, if you've got 200 million pounds and you're adding another 200 million pounds, depending on how your estimate is, it could be 200 million pounds less that 20% increment on that extra 200. So it could be like 360 to 440, right? So there's quite a bit of a range there, and I didn't feel I'd be able to get close enough, and then and I didn't want to be trying to second guess RPA, because that's really what it came down to. I have my number in my head where I think it's going to come out at, and it's probably not that far off from where your 50 subscribers have taken it. My recollection is the analysts out there are generally from 300 to 400. They're generally on the conservative end of things, so we'll see if that plays out this time. And the last CEO.CA, you were on 430?
440 was
440? Yeah, well, we'll see who wins out there, but I'm not going to stick my neck out on it. I do believe that it is out of date, though, as soon as it comes out.
Can we talk about the stock? There's been $1 billion market cap added since you were in this chair last year. 40 cents to $4. It's now, I think, $3.60 this morning or yesterday. Yep. So what's your view on the shares? Or is it a screaming buy still? Are you as excited about it as you were last year?
Well, I'm not as excited about it as it was last year. The reason last year was a very unique situation. We had the entire industry dumping all over NextGen. Meanwhile, they're coming out with good results, good results, good results. Well, you're well aware of the negative publicity campaign by all their competitors, the newsletter writers that were dumping on me and my estimate and the company, and the analysts. I remember sitting down with an analyst on Bay Street trying to get him to explain to me why he was at 40 million pounds. And I was showing him the math. I said, well, one drill hole almost gets you to 40 million pounds, so there's another 60 holes. How come you're at 40? And he couldn't tell me why, and I kind of got a sense I know why, because there were a lot of people ganging up on NextGen, so that led for that massive differential in valuation. Now after a year, people figured out that what was said by the skeptics at the beginning was completely wrong, and now we're starting to get some more sophisticated investors in the story, so that the pricing of it is getting much more efficient. So as far as going forward, what I see the pricing at is there's a couple of trends that'll take it forward from here. One is where we are in the uranium cycle. I'm starting to hear more people are talking about NextGen along the same lines as Cameco. They're saying, well, I need some uranium exposure. Should I buy NextGen or Cameco? So it's gone from a year ago today, from nowhere to actually being compared with Cameco as a way to get exposure to the uranium space. So if the uranium price continues to bottom, continues this bottoming here and continues to move forward, it's going to appreciate very, very well. The other thing that's going to happen to NextGen is after this second resource estimate, there's going to be a certain amount of indicated. And so based on that indicated resource, they can start doing some other work. And I anticipate they'll start moving forward, maybe not with a PEA or preliminary economic assessment or a pre-feasibility study. But what's going to happen is, as we're getting more sophisticated investors in it, they're going for a New York listing. We have large institutions all around the world invested in. We have Li Ka-shing has joined us, as you're well aware. We've had some big funds out of the U.S. are now invested in it. So what they're going to need is a feed for their models. So for them to be able to create their discounted cash flow models and start modeling up, well, how much money could the Arrow deposit make for NextGen shareholders, and they're going to need some numbers to feel comfortable plugging into those models, and that'll come from either a PEA or a PFS. So it's that kind of data that sort of needs to happen, and it will happen over probably the next year or so.
So that development phase is typically not as exciting for junior investors. Is there, or is it realistic in your mind that NextGen never will see a development phase and will be, the immediate takeout target that everybody wants?
Yeah, well, I've said to anybody who would listen that I wasn't aware of in my entire career of, and I asked everybody, I wasn't aware of a tier 1 deposit that was ever put into production by a junior, because the majors all need these exact types of deposits. I believe Arrow will be the biggest uranium deposit in the world when it's done drilling, and that drilling may take quite a number of years left, but I believe it'll be the biggest out there, and it'll be the asset to control the uranium market. It's that strategic, right? So an asset like that, I do not see a junior putting into production. It'll get picked off by somebody who wants to be in the uranium business, who wants to control the uranium business. So that's sort of my view on it.
I mean, I remember you flashing an insider signal, and I hate to get specific, but you had over 30 million shares, which was a massive win for your firm, and I know the question on everybody's mind is, do you still own them?
Yeah, I'm just sitting around 28, 29, just the snick under 30 million shares. So we're...
So you sold 3% of your position in your...
Oh, very small. Yeah, we sold very small. Over time we may sell some a little bit, but I believe that this coming year will be a transitional year for them, right? Because we're getting the next big resource estimate out, so it'll be clear to everybody by then. Any non-believers will believe that, wow, we've got a monster here. And with these results that have just come out on early drilling in 2017, it's clear that it's a monster and it's going to get bigger. So after a while, let's say I believe in the long term we're going to have 600 million pounds. Well, to produce 30 million pounds a year is a massive mine, right? And that would still have a 20-year mine life. So what's going to happen is over the next year, people will know it will be the biggest uranium discovery in the world, and then people say, okay, well, how profitable will it be? And you'll get, the resource estimate will help you understand that, because I know, let's say, take a look at the first resource estimate, half of the pounds were in the A2 high-grade shear, and that, if you just take a look at that high-grade zone, it's the equivalent of 5 ounces per ton gold. And if you or I showed up in front of this audience with a mine with 5 ounces per ton gold, you'd fall off your chairs, right? But that's happening today in NextGen. If you just look at the numbers and calculate it to gold equivalent, right? That's happening. So it's extraordinarily rich.
For investors, obviously, there's the commodity price swing that can move a story forward and fund flows. But really, the sweet spot for your fund has been, I guess, picking discovery success that hadn't yet been recognized by the mainstream.
That's right, yeah.
So how else would you describe your investing process?
That's it. That's where I think the sweet spot is. Like trying to predict the price of uranium, trying to pick the price of gold, it's really tricky. And so what I try and do is, one thing I can do is I could go on site visits and I could determine for myself whether we're onto a big discovery or not. We're on to other names also in other sectors. We have what I believe will be one of the world's biggest copper discoveries. We're one of the largest shareholders in that. And then
is that SolGold?
Yeah, it's SolGold. Is that my recommendation for everybody to jump into it? No, it isn't. There are risks, more risks to that than there was to NextGen. The reason I stuck my neck out on NextGen was because it was in the best jurisdiction in the world for mining, which is Saskatchewan. The management team is top-notch, and the discovery is top-notch. When we're dealing with SolGold, you're dealing with Ecuador. That's not Saskatchewan, and we're dealing with a management team that's halfway around the world. It's difficult to reach. So there are quite a bit more hurdles with SolGold than there is with NextGen. But I do own SolGold. I believe it's one of the biggest and richest new copper discoveries in the world, and we own about 4%.
So when you're picking stocks, what are the red flags that you try to identify first?
As far as whether I should stay away from the company or not, I can be here all day, but usually there's a strong correlation I find between how attractive the IR lady is and and how much I should probably stay away from the company is. That's a good one.
Well, I just want to say on that note that Sabina's investor relations rep is very beautiful. Nicole, she's here. It's also a very high quality stock.
Well, I thought you were talking about Bruce. He's not very attractive. Sorry, Bruce. No, I'm just kidding.
I guess I want to, for everybody in the audience to understand, how are you picking stocks, and how can they potentially deploy some of the same strategies if they're not necessarily geologists?
Yeah, the important thing to remember is, and I'm cognizant of our time here, but if we've just been through 5 years, prior to 2016, 5 years of the worst downturn I could remember, the worst downturn anybody I know in living memory could remember. What do you think, Dave? Was that pretty bad? We all lived it. We all lived it. It was rough. It was really rough. And one thing we all learned, I think, at the bottom of it is that most of these mining companies aren't worth very much at the bottom. And the reason they aren't, is because mining discoveries are extraordinarily rare. So we all need to remember that when, the mining sector here has bottomed. Things are going to get good. Things are going to get great. You guys are probably going to make a lot of money over the next few years. But remember, at the end of it, there aren't a lot of mines that come of these, some of these discoveries. They don't all turn into mines. And when the next downturn happens, they're all going to get crushed pretty badly. So that's an important thing to remember. I've been through a few cycles. I remember the crushing in the late 90s, and I watched people get vaporized. I had a friend, at least one friend I could remember off the top of my head, committed suicide. He was too exposed to a name. He blew himself up totally financially, and I tried to warn him well in advance to take some money off. He didn't take money off. So we've been to hell and back a few times here with the resource sector. It's cyclical. Remember that, it's cyclical. When you have a good run and you're feeling really good and you're feeling really smart, that's when I used to say, maybe I should just ring the bell and buy some real estate, and that served me well.
But you contradict yourself, because you just said that you're still holding 98% of your NextGen. It's up 10 times.
Yep.
So do you need to have a little chat with yourself?
Yeah, no, I probably do. A little self-reflection. Yeah, no, it's a very good point. What I think is going on with NextGen, NextGen is not a typical junior anymore, because I'm not saying it's blue chip, but it has some serious value underpinning it. And for it to get smoked really, really hard from here, you'd have to dream up a pretty extraordinary scenario, as in maybe another Fukushima, or maybe something equally as bad for it to happen. And I'm content to take that risk. And the important thing is, as a portfolio manager, is that is a very good question. It's not a day goes by that I don't think I should be, what should I be doing with my NextGen position? Some days I think I should double up. Some days I should take something off the table. But the important thing too is, when you do have a winner, and you believe the winner is a good one, and you believe it has a long way to run, and you have the patience, and my investors have patience, they've had a lot of patience with me, you just gotta let it run. And if you don't let it run, you're not gonna capture those gains. And I think NextGen, for the patient investor, should do quite well over the next coming years. But if you don't have a couple of year horizon, and you're a short-term trader, it might not be for you. Although sometimes we're getting some good swings in it, which are tradable. But
how are you putting new money to work?
Well, I've got some really interesting things. Like Sol Gold is one of them. We put some money to work there. We made some really good money there. I think we were up 5 or 6 times our money on that name. We've made a bunch of money in the golds. But my most exciting opportunity right now is we're invested in I'm backing some serious players in the oil patch in Africa that have a proven track record of finding oil. So it's very, very early stage, but that's where I'm deploying some of my funds right now. And it's a private company, unfortunately. Yeah.
But do you think maybe energy will have its moment for venture capital again, more so than mining?
Yeah, well, what's interesting right now is I can invest in mining or oil and gas. And I think what's happened with mining here is a lot of the really nice little juniors out there have just gotten way too expensive way too quickly. So they're quite expensive. I look at some of them. I know guys who hardly have any gold at all with 500, 600, 700 million market caps. So
but you promised no holds barred. You got to say who.
Oh no, they'll kill me. Yeah, they'll kill me if I said their names. But yeah, I talked to them personally and say, guys, come on, what's going on here? But yeah, so I look at let's say but right now I'm finding some good value in the oil patch, especially in the early stage oil patch. Nobody's giving them any money right now. Whereas right now, if you're an early stage gold company, you're financeable, right? And if you're not financeable, you have some serious problems.
Are there any commodity stories, like mining stories, that you think haven't been picked up, swept up by the winds and have value?
Yeah, there's one gold company I'm trying to buy some shares in. Unfortunately, I can't tell you what I'm doing, but I'm trying to hoover up as much as I can. And then There's actually, there's also a zinc story that I'm playing with too, trying to hoover up some stock, but they're out there, but you just have to look. You know, but you know, the first bounce off this bottom has happened, and valuations have recovered, as you're all aware. So you have to work a little harder to find the good value, but there's a few out there that are pretty good, and I'm trying to hoover them up for my fund. Yeah.
How do you see the next few years playing out? Are you going to make a bunch of money and sail off to the sunset, or are you riding the next bear market down just like the last one?
Yeah, I think I could pass on the next bear market, I think. But yeah, the reason I caught a good chunk of the last bear market because for some reason this last bull market didn't have any of the craziness that happened in the previous bull market, so I didn't really recognize the signs as much. But yeah, there are some opportunities here where you know, our little fund can make hundreds and hundreds of millions of dollars with some of these names. And
what's the special size, like the right size for a resource fund, do you think?
If you're dealing in just mining only, or mining, or oil and gas, see, the thing is with oil and gas, it's really scalable, so you could be huge. And that's why we like to put some money to work in oil and gas, because it's definitely scalable. In mining, you know, generally the smaller the better. You want to be probably bigger than 50 million. You probably don't want to be much bigger than 150 million. And that way allows you to go in and take a 10% position in, let's say, a $15 million junior, and still, you know, still be able to get a couple of those. Whereas if you're running $1 billion, a lot of the big gains are made in some of the smaller names, and you can't, it won't move the needle on $1 billion fund. But you know, even that being said, you know, you think I'd learn, but I'm not sure if you guys have been watching Tech Resources, like, holy man, oh man. You know, I watched it last time and I said, you know, next time tech goes to $4, I'm going to load right up. And I didn't load right up this time. And it seems to have a habit of going to $4 to $5 every downturn and going up to $30, $40. So, and you know, that's the old thing. Inco used to do that before they took Inco out. Like, I remember Inco used to be $2 and you go to $60. Like, there are some big ways to play this cycle when you're with some big capital. But
so yeah. Just to wrap up, if you had, say, a child or a nephew or a cousin entering the business, what would be maybe one or two key lessons that you would want to instill to them?
Well, that's a tricky one. There's lots of lessons to learn. Wow.
Mine would be trust but verify, and always sell before PDAC.
Yeah.
And I forgot to again this year.
Yeah, mine is, if there's one thing you need to focus on, I find, is the people. Because good people who know what they're doing don't waste their time on bad properties. And if you've got bad people who really don't know what they're doing, they'll promote the heck out of a bad property and make you try and feel it's a good one. But so if you're backing good, solid, proven mine finders, they will stick with good stuff, and if it's not good, they'll ditch it, they'll get another one. So that's really the essence of it. You need guys who are just straight up and honest with themselves. They have the skills to assess a property, and they're good, decent, honest guys.
Do you have an opinion on how much of one's portfolio should be earmarked for the high risk, high return venture space?
Well, for some people, zero. If you're, you know, if you're older, if you lose that X percent that you invested in, it's not coming back, right? But for most people, I find that if they have, you know, all their savings and retirement looked after, a lot of people just need a little bit of money to have some fun with in the markets, and invest in more speculative names. And if they're good at it, they can make some good money doing it. So I generally think less than 10% should be towards more speculative names, I think.
Yeah, that makes sense for me. Well, Warren, can I make you promise after you're finished soaking up the gold and zinc stock, you'll tell us about them?
Sure. And you know, rest assured, the people keep asking me, well, Warren, you're going to drop a name for everybody here at this conference. I said, no, I'm not. I said, NextGen, you guys don't realize NextGen, like, they don't come around too often. They're very rare. And I'm kind of like Warren Buffett in that I wait for the fat pitch. I wait for the real juicy name, and then I throw everything at it. And that's what I kind of do. And they don't come around too often. There will be another one coming around, and I can assure you, I promise to you, if I feel that there's a risk reward as compelling as NextGen is, with the amount of upside available, I'll make sure we'll sit down and we'll do a little article on it. How's that?
Thanks, Warren.
All
Appreciate you being here.
Thank you.
Great to see you.